September 2015. One of the most respected companies in the world was caught doing something that sounded impossible. Volkswagen had built cars that could lie, not to customers, not to drivers, not even to investors. According to American regulators, the cars were designed to lie directly to the government itself. Within days, the company that symbolized German engineering excellence became the center of a global scandal. The accusation wasn't about a defective engine. It wasn't about a safety problem. It wasn't even about a failed product. Regulators claimed Volkswagen had intentionally installed software that could detect when a vehicle was being tested. During official emissions tests, the car behaved one way. On real roads, it behaved another. The company wasn't being accused of making a mistake. It was being accused of building a system designed to deceive. Investors immediately understood the danger. Trust is one of the most valuable assets a company can own. Volkswagen had spent decades building that trust. Now it was evaporating in real time. Within days, tens of billions of dollars disappeared from the company's market value. To understand the scale, Volkswagen lost more value than many Fortune 500 companies were worth. The market wasn't pricing in a technical issue. It was pricing in fraud. The numbers became even more shocking as investigators dug deeper. More than 11 million vehicles worldwide would eventually be linked to the scandal. Governments opened investigations. Lawsuits multiplied. Criminal probes followed. The total financial damage would exceed $30 billion through fines, settlements, recalls, compensation programs, and legal costs. Few corporate scandals in modern history have produced a bill that large. But the money wasn't the most disturbing part. The disturbing part was that somebody had approved this. Engineers didn't accidentally create software that recognized government tests. Executives didn't accidentally approve years of misleading marketing. Somewhere inside Volkswagen, people understood exactly what was happening, and for years they kept the machine running. The strange part is that Volkswagen didn't need to cheat to survive. This wasn't a struggling startup facing bankruptcy. This wasn't a desperate company trying to avoid collapse. Volkswagen was already one of the largest automakers on Earth. It generated billions in revenue. It sold millions of vehicles. Yet somehow, even that wasn't enough. For years, the plan worked perfectly. Customers bought the cars. Dealers praised the technology. Journalists wrote positive reviews. Investors celebrated strong growth. Volkswagen convinced the world that it had solved one of the biggest challenges in automotive engineering. Nobody knew they were looking at an illusion. And because the illusion was profitable, very few people had a reason to question it. Then a small group of researchers noticed something strange. Their project wasn't supposed to expose one of the biggest corporate scandals of the century. They weren't prosecutors. They weren't regulators. They weren't whistleblowers. They were simply comparing emissions results in the real world. What they discovered would eventually trigger an investigation that cost Volkswagen more than $30 billion. The question isn't whether Volkswagen cheated. The company would eventually admit that. The real question is much more interesting. How did one of the most respected engineering companies in the world convince itself that lying was a better business strategy than telling the truth? To understand Dieselgate, you first have to understand Volkswagen's ambition. By the early 2000s, the company wasn't chasing profitability. It was chasing dominance. Volkswagen wanted to become the largest automobile manufacturer on Earth. Bigger than Toyota. Bigger than General Motors. Bigger than everyone. Inside the company, growth wasn't simply a goal. It was an obsession. At the center of that ambition stood Martin Winterkorn. Intelligent, demanding, and famous for his obsession with detail. Winterkorn believed Volkswagen could dominate the global automotive industry. Employees described a culture where mistakes were not welcomed. Expectations were extremely high. Results mattered. Excuses did not. Under his leadership, Volkswagen expanded aggressively and pushed toward its dream of becoming number one. The company already controlled an empire of brands. Audi, Porsche, Bentley, Lamborghini, Skoda, and several others operated under the Volkswagen umbrella. Sales were strong across Europe. Revenue was growing. Investors were happy. Yet one market remained frustratingly difficult to conquer: America. Winning the United States represented billions of dollars in future revenue and a major step toward global leadership. Volkswagen believed diesel technology could unlock that opportunity. Diesel engines were already popular in Europe because they offered excellent fuel economy and long driving range. Executives believed American consumers could be convinced to embrace diesel too. If Volkswagen succeeded, it would gain a major advantage over competitors and dramatically expand its presence in one of the world's most valuable automotive markets. The strategy became known as clean diesel. Volkswagen promised customers something that sounded almost perfect: perfect. Strong performance, excellent fuel economy, low emissions. Drivers wouldn't have to choose between efficiency and environmental responsibility. They could have both. Advertising campaigns repeated the message everywhere. Dealers repeated it. Executives repeated it. Investors loved it. The opportunity was enormous. America represented millions of potential customers and billions of dollars in future profits. Winning even a small percentage of additional market share could generate huge financial rewards. The money trail was clear. More diesel sales meant more revenue. More revenue meant faster growth. Faster growth meant Volkswagen moved closer to becoming the biggest automaker in the world. For a while, everything looked perfect. Diesel sales increased. Market share improved. Investors rewarded the company. Analysts praised the strategy. From the outside, Volkswagen appeared to be solving one of the industry's hardest problems. Inside the company, however, engineers were discovering something that threatened the entire plan. And that problem would eventually change everything. The problem started inside Volkswagen's engineering departments. American emissions regulations were far stricter than many executives expected. Regulators wanted diesel vehicles that produced significantly lower levels of nitrogen oxides, commonly called NOx. These pollutants are linked to respiratory problems and environmental damage. Meeting those standards consistently wasn't easy. Engineers quickly discovered that the company's goals were beginning to collide with reality. Volkswagen wanted three things at the same time. It wanted strong performance, it wanted excellent fuel economy, and it wanted extremely low emissions. The problem was that improving one area often hurt another. Engines that produced lower emissions could lose performance. Engines optimized for performance could struggle with emissions requirements. The company was trying to achieve a combination that was proving far more difficult than its marketing suggested. As development continued, pressure inside Volkswagen increased. Executives had already committed to the clean diesel strategy. Advertising campaigns were underway. Dealers expected vehicles to arrive. Investors expected growth. The company had publicly promised a solution. Walking away would be embarrassing, expensive, and potentially damaging to Volkswagen's long-term ambitions in America. For engineers, the situation became increasingly uncomfortable. Technical limitations were colliding with business expectations. The company wanted results. Regulators wanted compliance. Customers wanted performance. Everyone expected Volkswagen to deliver all three. But the closer teams got to production, the clearer it became that meeting every objective simultaneously would be extremely difficult. This is where the money trail becomes important. Volkswagen wasn't simply trying to sell cars. It was trying to secure billions of dollars in future revenue. America represented one of the largest automotive markets in the world. If the clean diesel strategy failed, years of investment could be wasted. Market share targets would be missed. Growth projections would collapse. The financial stakes were enormous. Inside many corporations, pressure creates innovation. Inside others, pressure creates shortcuts. Investigators would later argue that Volkswagen gradually moved toward the second path. Instead of lowering expectations, delaying plans, or admitting technical challenges, the company began searching for another solution. A solution that could satisfy regulators, customers, and executives at the same time. Eventually, that solution appeared. It wasn't a revolutionary engine. It wasn't a breakthrough in environmental technology. It was software. On paper, the idea looked clever. In reality, it would become the foundation of one of the biggest corporate scandals in modern business history. The software later became known as a defeat device. In simple terms, it allowed the vehicle to recognize when it was being tested by regulators. During official laboratory tests, emissions controls operated at maximum levels. The car appeared clean and compliant. Once testing ended and normal driving resumed, the vehicle switched to a different operating mode. Performance improved, but emissions increased dramatically. From a business perspective, the solution appeared almost perfect. Volkswagen could continue advertising clean diesel technology. Regulators would see passing test results. Customers would receive the performance they expected. Sales could continue growing. The company could protect its strategy without redesigning major parts of its engine program. The only requirement was simple. Nobody could discover what was happening. For several years, nobody did. Volkswagen continued expanding its its diesel business. Customers bought vehicles believing they were helping the environment. Dealers promoted the technology with confidence. Investors saw rising sales numbers and strong growth prospects. Every successful quarter reinforced the belief that the strategy was working exactly as intended. The financial rewards were substantial. Diesel models became central to Volkswagen's American growth plans. Revenue increased. Market share improved. Executives received praise for the company's progress. The deception wasn't creating short-term gains. It was helping support a long-term business strategy worth billions of dollars. The more successful the strategy became, the harder it became to abandon. Then something unexpected happened. The threat didn't come from a competitor. It didn't come from a disgruntled employee. And it didn't come from a journalist. Instead, it came from researchers who simply wanted to compare emissions performance under real-world conditions. What they discovered would eventually expose everything Volkswagen had worked so hard to hide. In 2013, researchers working with the International Council on Clean Transportation, or ICCT, began a relatively simple project. They wanted to compare diesel emissions in the United States and Europe. The goal wasn't to expose fraud. The goal was to collect data. To make the research more realistic, they tested vehicles outside laboratory conditions using portable emissions equipment mounted directly on the cars. The results immediately raised questions. During official government testing, Volkswagen's diesel vehicles produced emissions that met legal requirements. On actual roads, however, the numbers looked completely different. Some tests showed nitrogen oxide emissions many times higher than regulators allowed. At first, researchers assumed there had to be a technical explanation. The gap seemed too large to be real, so they tested again, then again. Different routes, different conditions, different vehicles. Yet the pattern remained remarkably consistent. Laboratory performance looked excellent. Real-world performance looked terrible. The more data researchers collected, the harder it became to dismiss the results as an accident or equipment failure. The findings eventually reached regulators in California and the Environmental Protection Agency. Their initial reaction wasn't outrage. It was confusion. Modern vehicles sometimes perform differently under real-world conditions, but the discrepancies appearing in Volkswagen's data were unusually large. Regulators began asking the company for explanations. Volkswagen responded with technical arguments. Engineers suggested there might be software calibration issues. Other explanations pointed toward unexpected operating conditions. The company proposed updates and modifications. On the surface, the responses sounded reasonable. Regulators continued investigating, believing they were dealing with a complicated engineering problem. But every new test created the same contradiction. The vehicles behaved normally inside testing environments and abnormally outside them. Investigators started asking a more uncomfortable question. What if the cars weren't failing emissions tests? What if they were specifically designed to pass them? That possibility changed everything. A technical defect would be embarrassing. Deliberate deception would be catastrophic. One represented an engineering failure. The other represented corporate fraud. Suddenly, Volkswagen was no longer defending a product. It was defending its credibility. Inside Volkswagen, pressure intensified. The company knew regulators were becoming more suspicious. Engineers and executives faced growing scrutiny. Every request for information increased the risk that investigators would discover how the software actually worked. The strategy that had protected billions of dollars in revenue was beginning to attract exactly the attention it was designed to avoid. The situation became even more dangerous because the stakes were no longer limited to America. If regulators proved Volkswagen had intentionally manipulated emissions tests, the scandal could spread globally. Millions of vehicles were potentially involved. Billions of dollars in revenue were connected to the diesel program. Entire careers, reputations, and business plans suddenly depended on keeping the truth hidden. Then investigators found what they had been searching for. Evidence suggested the vehicles could detect specific testing conditions and alter their behavior accordingly. The mystery that had confused researchers for years finally had an explanation. Volkswagen's problem was no longer whether regulators would discover the deception. It was how much damage would follow once they did. By 2015, regulators had reached a conclusion. The discrepancies were not accidental. According to the EPA, Volkswagen had installed software specifically designed to defeat emissions testing procedures. Years of suspicion instantly became one of the biggest corporate scandals in modern history. The announcement hit the business world like a bomb. Investors reacted immediately. Volkswagen's stock collapsed. In only a few trading sessions, the company lost tens of billions of dollars in market value. To put that into perspective, the amount destroyed was larger than the total value of many publicly traded corporations. Shareholders who trusted Volkswagen watched enormous amounts of wealth disappear almost overnight. The public reaction was equally severe. Customers who believed they had purchased environmentally friendly vehicles felt betrayed. Governments launched investigations. Journalists uncovered new details almost daily. What had once been a celebrated growth strategy was now being described as one of the largest corporate frauds in automotive history. The pressure quickly reached the highest levels of leadership. Martin Winterkorn, the CEO who had spent years pushing Volkswagen toward global dominance, resigned within days of the scandal becoming public. One of the most powerful figures in the automotive industry suddenly found himself associated with a deception that had shaken the entire company. The scandal was now public, but investigators were only beginning to understand its scale. As regulators gained access to internal records, emails, engineering reports, and company communications, they started asking a much more dangerous question. Who knew? The existence of the software was no longer in dispute. The real battle was determining how high inside Volkswagen the knowledge had reached and how long the deception had been allowed to continue. Governments around the world launched investigations. The United States pursued civil and criminal cases. German authorities opened their own inquiries. Other countries demanded answers about vehicles sold within their borders. What began as an American emissions investigation rapidly became a global corporate crisis. Every new regulator wanted documents. Every new regulator wanted testimony. Every new regulator wanted accountability. Lawsuits arrived from every direction. Customers sued Volkswagen for misleading advertising. Investors sued Volkswagen for failing to disclose important information. Governments sought penalties for environmental violations. Dealers faced angry buyers. The legal assault became so large that Volkswagen found itself fighting battles in multiple countries at the same time. The company was no longer defending a product. It was defending its survival. The money trail became impossible to ignore. Vehicle buyback programs alone cost billions. Compensation funds cost billions more. Regulatory penalties continued growing. Legal expenses piled up. By the time settlements, recalls, fines, lawsuits, and operational costs were added together, the total damage exceeded $30 billion. That amount could fund major transportation systems, universities, hospitals, and public infrastructure projects across entire regions. The scandal also produced criminal consequences. Several executives and employees faced investigations and charges. Some argued they were following instructions. Others denied responsibility. Prosecutors claimed the deception could not have existed without people making conscious decisions. The question that had haunted the scandal from the beginning remained unchanged. Was this the work of a few individuals, or was it the product of a corporate culture that rewarded results regardless of risk? What made Dieselgate different from many corporate scandals was that Volkswagen didn't collapse. Enron collapsed. Lehman Brothers collapsed. FTX collapsed. Volkswagen survived. The company remained one of the world's largest automakers. It continued selling vehicles. It continued generating revenue. Yet survival came at a massive cost. The company spent years rebuilding trust that had taken decades to create. Looking back, the most important lesson isn't about software. It isn't about diesel engines. And it isn't even about emissions. The real story is about pressure. Volkswagen wanted to dominate America. Executives wanted growth. Investors wanted results. Engineers faced impossible expectations. Somewhere between those ambitions and those expectations, telling the truth became less important than maintaining success. The fraud didn't begin with criminal intent. It began with a business target. Today, Dieselgate remains one of the clearest examples of how a successful company can create its own disaster. Volkswagen had money. It had talent. It had market power. It had global respect. Yet none of those advantages prevented one decision from turning into a $30 billion catastrophe. And that leaves a final question. If one of the world's most respected engineering companies was willing to bend reality to protect growth, how many other companies are still doing things that nobody has discovered yet?